Morning, everyone. We're just waiting for some more participants to join. We've got quite a few people joining today. Just give it a few more moments. Morning, Mark. We'll just give it a few more seconds. Just give some of the people a chance to log on. Okay, I think we'll get started. I think we are expecting a few more people, but it's great to have everyone with us today. Thank you for your time. I know you're inundated with webinars and everyone's screaming for some of your time, and you probably zoomed out. It's fantastic that we can spend time with you like this. Obviously, it would be great to see you in person, and we do miss the interactions with everyone. It's getting a little bit lonely, but I'm sure in the not too distant future, we'll find a sort of a balance between in-person events, and we'll definitely continue with the convenience of these Zoom meetings as well. So thank you very much for joining us. This is our webinar on timing the market versus risk control. You know, we really thought about what's a pertinent, relevant topic at the moment, and I think you'd agree with us that this is quite an interesting topic at the moment. I'm sure you'd have seen that we do see our asset allocation calls differently at the moment. We're very nervous in our balanced funds about what's going on in the market. We want to share some of the potential risks that we see out there with you. Where do we see the opportunities, I suppose, more importantly, going forward in these unprecedented times? Where do we see the opportunities going forward? And also just to share with you how risk management essentially is the core of our investment philosophy at Rezco. On the call with me today, I've got Rob Spanjaard, who I'm sure you've met. He's our Chief Investment Officer and co-PM, with Simon Sylvester, who is also our co-PM and Head of Research. I suppose just a little bit of house rules. We would love to answer your questions, and we'd love the webinar to be engaging. There is the Q&A icon at the bottom of your screen. Simon will be manning that. And what we'll try to do is we'll try to answer your questions. We'll try to get to all your questions. Simon will answer them at the relevant time in the presentation, and then we'll obviously have time at the end. Just something to emphasize, please feel free, if we do have questions and it does take us past 11 o'clock, please feel free to leave. You will still get your CPD certificates. It's not the end of the world. We respect your time, but we also want to try and get to everyone's questions. If we don't get to those questions, please, we can email you the answers to those questions. And with that, I'll hand over to Rob. He's going to be flying he's going to be the pilot today. And with that, over to you, Rob.
Right, Brian, thank you. And yeah, welcome to everyone. It's nice I'll use the word, see you all. I know I can't see you, but you can see me. It's great to be able to do that. We love doing it as a team. We love talking. It's very interesting markets. We're certainly fascinated by it. And the topic we think really works in the current market. You know, this concept of time the market versus risk control. It's important what we mean on it. You know, I was in Cape Town over the weekend or for the whole of last week, and I had a young chap in a Bitcoin discussion. I'm sure you get those who have clients would have a lot of those. Why should I not put my money in Bitcoin right now? And now with Bitcoin, I haven't looked at it for a week or two, and I lost it. I think it was at 50,000. And I was trying to explain to the guy about risk. Now, I would have given him the same speech when Bitcoin was 20,000. And it's now about 50,000. Now, that really highlights what we're trying to talk about. Was I wrong to say don't buy Bitcoin at 20,000? On one level, yes. You could have been 50,000. But Bitcoin at 20,000 was a very, very high risk investment, and not something to do with your retirement savings or your university fund. It's your dabbling money. Now, the problem with the market we've got into the whole jolly things become a little bit of a casino. And what we so Simon and I have done, we're doing a lot of presentations, and we're probably a little bit early trimming risk back last year. Is it wrong to manage risk? We always think it's very important to manage risk, and it's right at the core of what we're trying to do. The risks have got a lot worse in our market. Now, there are opportunities, and we'll try to talk about, we're not, otherwise we'd be running an income fund. There are opportunities, they're great opportunities, but the risks are building, and it's very important that investors are cognizant of that and think about it. So some of the ideas we're putting out there, just defining that this difference between timing the market, that's trying to get buy every dip and sell every peak. And you're in and you're out, and it's up and I'm going to get out, and ultimately we're not trying to do that. I don't know if we don't think we would be good at it, but we're rather trying to manage risk, because risk and return, very important, the return part, because we're trying to get risk adjusted returns, and we're trying to, managing risk from our side is choosing when to reduce risk asset exposure based on an objective risk management framework. You've got to have a framework where you're thinking about risk, and when is it, like, I'm not going to play Bitcoin. And it's a different, when is that just a very, very high, or for example, buying shares that just have no earnings. They have no earnings, making losses, and it's questionable whether they will ever make a profit. Now, to that, they might double, they might treble, they might quintuple. A good example is Tesla. You could have made a lot of money out of Tesla last year, but Elon Musk himself was quoted as saying they're a week away from going bust, in which case you would have lost all your money in Tesla. As it happened to turn out, the market pushed it through the roof. That's not what we're trying to do. We're trying to find relatively low risk bets, which over time work for our clients. Part of our framework on it is this grey rhino thing. Last year, we spoke quite a bit about it. Black swans, something badly goes wrong, and everyone's like, it's a black swan hit us. The grey rhino, if you remember, I've got the definition here, is a highly probable, yet high impact yet neglected threat. They're not a random surprise. There's a series of warnings and visible evidence. So you get the game farm. We live in South Africa. We can relate to a game farm analogy. You have a rhino standing there. It's eating grass. It's dangerous. You keep an eye on it. You can even get out the vehicle. You can take some risk. Don't get too far from the vehicle. And whatever you do, don't forget about the rhino, because it's going to be a bad experience. That's really encapsulates this grey rhino thing. Understand there's some risks. And sometimes the longer the rhino sat there eating grass, the more you think it's just completely benign. And we'll take you through some of our thinking in this regard, where we see that. Highlighting what we were talking earlier, we always try to put the slide up. What we're aiming for at Rezco is the combination of risk control and getting alpha, getting outperformance for our clients. We're not interested in we don't see risk as as the risk of being worse than opposition. A lot of the times in asset management, that's the risk that we underperform our peers. We don't see risk like that. We want to take, was the return we got justified by the risk we took to get it, and a risk of permanent impairment or long-term impairment of capital. So this is what we've done, as you know, over the years. That's Rezco Value Trend. That's a CISA multi-asset high equity group. We're just trying to keep this line consistently over time with as little fuss as possible, going from bottom left to top right. And we've consistently done it. This is not our first rodeo. We've been through some tough market environments. And we clearly would be underperforming at the moment because you've got less risk, but we're still going up. We're still making our clients money and achieving what we're trying to do, in the context of trying to not take massive risk bets in it. So where are we now? We can talk about a lot, and we were prepping the presentation. We started adding a whole lot of stuff in. Let's chuck in the bonds, and because it's multi-asset funds, and we have, obviously, our equity fund isn't, but And we thought, no, you've got to kind of focus this thing. We only have an hour of your time. And then obviously for those who can stay, we've got some questions, and please drill those questions as we're talking. So Brian said that where we find is really good is Simon's got it and there's a question, we can talk about it while we're at the slide. And very often, and that makes it really interactive. So we're in an environment of very expensive markets. Nothing new here. There's MSCI World Market, the price earnings ratio up here at 20. That's way above the range of 14, 16. The longer it sits there, the more we get used to it. But that's an expensive market. Russell 2000 in the US, smaller companies, often guys say, no, it's just that the FANGs are just expensive. No, this is the 2000 smaller companies, the next 2000. That's very expensive. PE of 32 versus a range from 20 to 25. That's an expensive market. This is an interesting way of looking at it. It's a ratio called EV/EBITDA, which is a kind of, for those who are not financial people, the blue is the EV/EBITDA. Sorry, we've also put in the PE so you can relate to it. But the EV/EBITDA is interesting because it takes into account debt. I won't bore you with the details, but it takes into account how much gearing companies are taking on, and it's often we use it in our analysis. It's a better measure of valuation. Then PE can sometimes be a bit crude. So on that basis, on PE, forward PE. Now this is important to note that that's with this brilliant earnings over the next year. That's the next 12 months earnings, this booming economy. That's all baked in. That's all in the numbers here. It's not got coronavirus earnings. And this, we've excluded tech. So it makes this a direct comparison. Take out the tech shares, because a lot of people say, yeah, it's just the tech companies that are expensive. So take out the tech companies. On a straight PE basis, on a forward PE, it's the same as a 2000 bull market. On a EV/EBITDA, which is a better way of really measuring it, because you include the amount of debt, and companies are layering lots of debt, which means more risk. On EV/EBITDA, it's a lot more expensive. It was at that peak was about 13, you're now at 16. That's 20% more expensive than the top of the 2000 bull market. Emerging markets, let's not only think a greater world or America. That's the MSCI EM index, the red line, and the blue line's the PE of that. You can see that that's expensive as well. Now we'll talk about South Africa, because a lot of people say South Africa, the markets do it cheap. It's not and I know some of our competitors and our colleagues in the industry see that one a bit differently. So I will circle back to it in a couple of slides time. So we're firstly talking the long-term picture, what can go wrong? Because we're saying, look, there's risks building, and these are fairly end of cycle type of risks. And so here's a graph of going back 150 years of the stock market cycles. And very important point to note is that little dot where we are now, the top. To be quite frank, I don't know. Simon doesn't know. We asked Brian didn't know either. It's not our job to try work out, are we exactly at the top? That's market timing. That's trying to say, look, I'm going to get out over there, 1929. In Black October, I'll get out in September. But the point is, in October, you didn't know it was the top. 68, 2000, no one rang a bell. Even the 2007 peak of the market, you don't know when exactly there's a top. All you know is that you're playing in a place of quite high risk. And the biggest similarities to our market is 2000. Very, very expensive tech shares with no earnings. Funny things is happening like SPACs, a market that's becoming completely disinterested in risk. Shares trade on things like FOMO, flavor of the month. It becomes a market that detaches a little bit from reality. It's very important to note over here, Warren Buffett was called a dinosaur. It's like Buffett doesn't, because he famously didn't participate in the tech boom. So no, Buffett's a dinosaur. Dinosaur still seems to be going. Fairly old dinosaur now. And there's a lot of the the hotshot investors are the ones who are going to extinct there. So just traditional measures of value, and a company over some period of time has got to produce a whole lot of cash. Otherwise, why did you buy it? So if you take where we are in this market, these are long-term cycles, and to just reiterate it for the nth time, does it turn tomorrow? I don't know, but we just got to know the risk you're taking on. This is historical price earnings ratio of the S&P index of the US going back 150 years. And you can see where we are now. It's a very expensive market, extremely expensive. Now, there's always the arguments of interest rates, and I've got another graph which can explain it's not necessarily true that interest rates justify where our market is now, because you've essentially had a huge bull market in bonds. So if you look at the bond rate, the US 10-year as an example, the 10-year bond, and you say, look at the rate on the 10-year bond, shares aren't that expensive. You're using one insane bull market to justify another one, which is dangerous. And then there's a lot in the presentation. And I guess the gist of what we're saying here, there's a lot of commentators deeply concerned about inflation. And the interest rates are not going to stay down here. Because of the macro policy. That's why we brought in quite a few slides, because interest rates start going up a lot, you're going to have carnage. So what goes wrong at these peaks? It's important. We just slide to, because we're in an environment here. Sorry, excuse me one more time to jump back a slide. We've had a bull market since 2009. It actually wasn't a very long bear market. If you only started investing in 2010, own equities only go up. They never go down. But what can happen? We're just taking some bear markets over the last 100 years. The PE of the market at the peak. We've taken it because shares over time get more and more expensive. We said, look, what's the 25-year average of the market at that time? It's a moving average. So it was 16 in 1906. Now the average of the last 25 years has been a PE of 20, a historical PE. And we said, look, what's the ratio of the current PE to the historical 25-year average? And we're now sitting at about 1.56. Interesting in 2007 with the GFC, because it didn't even get above 1. But there's two things we'd like to highlight. If something goes wrong badly, the drawdowns 69, 81, 55, 63, 59, 52, the carnage isn't 10%. And then this is even more concerning. Why you've got to take risk into account, in our opinion. You waited 22 years to get your money back in real terms. 29 years, then 17 years. So this is all inflation adjusted numbers, the years. In the 2000 bull market, it took you 15 years to get back to get your money back, to break even. If you got in at the peak of that bull market, 15 years later. 2007 was quite quick. That was only 6 years, but it's still a nasty period of time. And you say, so the context of, look, if the market, what we learned from Corona, what the market learned is, if the market falls, just do nothing. Put your head in the sand, go to sleep. It always comes back. History says that's not true. History said the most recent one, we don't want to kind of dig up 1906, but 2000, which is very comparable to now. It took you 15 years to get your money back.
Rob, maybe
sorry, Simon.
Rob, just to add on to that analysis, just to make sure it's clear, those PEs there, I don't know for those who are familiar, but with Schiller's work, but those are kind of through the cycle averaged earnings. So what's important where we are in the market at the moment is, if you're looking at kind of spot valuation metrics, there's a lot of companies that are on peak earnings, which can distort your view of the market. But economies also work in cycles, not just equity markets. So if you're at peak earnings and the economy hits a wobble, those earnings can go backwards. So the earnings can fall, the share prices can fall, but not necessarily get that much cheaper. And that's how you end up with these long drawdowns in the market that go over many years, because earnings are falling, shares are getting cheaper. The shares are falling, but the valuations aren't necessarily getting cheap because there's this earnings hit. We didn't experience it in this COVID crash because of, as we'll see, we've got some slides on how the economy was propped up. But that's really what gets you in these 6-10 year kind of cycles. This headwinds to earnings over multiple years after these peaks in the market and or peaks in the economy kind of coinciding.
Right, thanks, Simon. Yeah, just to reiterate, this previous slide that's inflation adjusted on the S&P over the long term. But these PEs are actual PEs and then the 25-year average. So coming back to South Africa, lest we forget where we actually live, and a large portion of our equity fund is South African only. We spend a lot of time thinking about South Africa. Very important in our lives. Our balanced funds invest in South African equities. Big portion of the where we generated the returns over the years. So South Africa, we have this thing, yeah, but that's international. South Africa, a lot of people are saying South Africa is very cheap. Okay, so we look at it in two ways. If we look at straight historical PEs, let's strip out Naspers because it was all share excluding Naspers. We've actually started to look at capped SWIX more. All shares become a bit of a funny index, but let's strip Naspers out of the historical and yeah, fairly expensive. It's not cheap, but obviously you would say forward-looking earnings important. So we split two sectors. Let's first look at the banks here. Banks they're not cheap. They're not particularly expensive. And this is the average of all the banks forward earnings. This includes recovering from the hits that they took in 2020. That's not it's slightly above average over the last couple of years, but depends on your view. We think South Africa is still in a recession. I'll talk. I've got a slide or two where we talk to that. If you feel South Africa is just at the cusp of a new wave of pumping economic growth, which certainly we hope for, and we've got a fair amount of SA Inc. shares in our equity fund, but there's some concerns that we express. It's not a particularly cheap market. It's kind of average-ish, and we think there's a bit of risk. There's some for our banks or retailers, there's some asymmetrical risk that you need to think about. If you look at our mining shares are cheap. That's why if you just look at the overall index or the cap SWIX and you look forward to earnings, you can say, wow, look at the PE, it's cheap because our industrials or banks are okayish. Our mining shares are actually darn cheap. Now, we own a fair amount of mining shares in our balanced funds. That's the kind of one thing we really do own quite a bit of. Or equity fund. I mean, about 40% of all shares now are mining shares. So you can't ignore mining. Our equity fund has a fair amount of mining shares. We like them. We think we've done a lot of very, very detailed analysis on particularly the platinum miners, and they're making more money out of rhodium now. So maybe we should call them rhodium miners. With John Williams on our team, he was ex-head of Anglo-American commodity forecasting. He knows the industry, the players, who's mining what, who's using what. It isn't something we do lightly. We think those earnings carry on for a while. So with electric vehicles coming in very aggressive, we model this thing to pieces in very, very detail. So we're comfortable in some of the risks there, and we own in Value Trend, for example, Managed Plus or Stable Fund. We own what we actually own. We own quite a lot of mining shares or equity fund too. But where you've got to be a little bit careful, it's cheap and the earnings look good, is there are cyclicals. So a lot of what you're finding even applies to the internationals. Where you're finding cheap shares, they tend to be cyclicals. So you can say it's great, look how cheap this thing is, but cyclicals tend to be cyclical. You're taking some risk there, but at the moment we're happy. That's the one place where we can get quite excited, because it comes out a bit in the presentation on inflation. There is a school of thought that the commodities could do quite well.
So
Okay,
Rob,
here's
just a
one of our-
question.
Yeah.
Just a question. Lubabalo's got a question on just the PEs for the mining companies. You're right, Lubabalo. The PEs, you've got to be a bit careful on mining shares, just looking at PEs. Obviously, for the presentation, we didn't want to bore you with all the statistics and that we look at, but we'll look at discounted cash flows, EV/EBITDAs, cash yields. And very importantly, what we do differently is we take quite a strong view on the underlying commodities. So we model the underlying commodity supply and demand in detail, so that we understand where the commodity price from which they mine, where they generate their revenue from. So we model that in detail. So there's a lot of work that goes into modeling a mining share. And specifically, we focus a lot at Rezco on taking a view of the underlying commodity and not just modeling the actual mining company's valuation metrics, because then you can get caught with the wrong price assumptions, and then you can have a great model, but if your price assumptions for iron ore or rhodium or something like that are horribly wrong, you're gonna get the call wrong. So there's a lot of detail that goes behind that, but across all the metrics, in fact, PE, they look cheaper on other metrics because they're generating so much cash, and a lot of these mining companies are sitting on net cash. Their kind of EV/EBITDA, for example, looks a lot better than their PE. So this is actually understating how cheap some mining companies are at the moment. But yeah, it's a good question.
Yeah, I mean, just on that, John, when his previous job, which he did for many years, they used to, when you got to dig a hole in the ground and own the mine for 30 years, you'll forecast that cash flow for 30 years and the commodities. We have a luckier, easier job in our world. We only want to own these things for 4 or 5 years. And we can sell if things are going pear-shaped. We can get out. So yeah, you do. And reiterating what Simon says, probably your most important thing is how much cash does this thing generate over the next 5 years? And if you get your commodities wrong, you are dead. But let's not get totally lost on that. One of our concerns on South Africa is this graph we did on. If you look at retail sales, like there's a very interesting thing happening here. Change in total retail sales. So you can see the red line, April, we were down 46%, and then it recovered very quickly till August, and then in February was back to normal. So you can see over here, year on year, from August, there was no damage from COVID. But the problem, if you take out the COVID grants, just this is not all government grants, just the specific COVID grants, you can see the picture would have been much worse. Now, the point we're making is that we had a 4.9% growth in February 2021, would have only been 1.8. Now, this is where the COVID grants drop off. And that's impacting through the South African economy. You had a boost from lower interest rates of about a 30 billion rand. You had about a 70 billion extra COVID grants. Don't hard bake them in to your economic assumptions, because we're not America. We can't just give away money to everybody. There is some school of thought I was reading over the last week or two where they want to have a basic income grant and just carry on handing out money. But that would certainly have other problems that we need to be careful and cognizant of. So we are of the view the South African economy is not really growing. A good proxy, an imperfect proxy, is electricity. And you can see this is the 3-month moving average of our electricity production. It's not our reading over the weekend. Impala platinum production, or PGM production, down 7% because of load shedding. This is a drag on the economy, but it's also an underlying indicator of how our economy is going. Not a perfect indicator. Probably a more important one is gross fixed capital formation. You can see we're not investing as a country. And there's going to always be a link between that and GDP growth. The thing to remember as well, and we're debating, do we put in a whole lot of fixed income slides? It's something we spend a lot of time thinking about, but we eventually decided, look, we've got to talk about something. But one of the concerns, this is where the South African 2021 budget, this is our budget deficit as a percentage of GDP, pegging of 7-8%. That's with a very good assumption that Minister Mboweni can stick the government labor unions with pretty much nothing of an increase, and he can pull it off. And we don't start doing government grants to everybody, and we can stop the government grants, and they can limit total government salary bill to pretty much zero increase. Probably most likely, sorry, my apologies there, we actually end out in about the 8% range on government deficit, but even at 6%, that's still a very big deficit for emerging market. And that's why we can't carry on just printing money and handing out grants. Okay, so we're saying world markets, of which we want. South Africa, what's pushed us along is this tremendous world market we've had, and we said there's a major dislocation, there's risk of one. So we like certain commodities. We obviously formulate our own views. We do a lot of primary research. We subscribe research we pay for people who know much more about certain topics, particularly international economy, US economy. But you also look at what very seasoned, respected people are saying around the world, because if you just look at certain channels, it feels like a boom. And I'll give a good example of that now. But Larry Summers, finance minister in the US. He's a Harvard professor. He's a seasoned, and he's a liberal. He's got no reason to be criticizing the Biden administration. He's had a series of these things where he's getting positively hysterical. I'm concerned that what is being done is substantially excessive. It could manifest itself in a euphoric boom and optimism that leads to unsustainable bubbles, or it could all work out well. But it doesn't seem to me that the preponderant possibility is that it'll work out well. He was saying over the weekend, being interviewed on Bloomberg, I'm a progressive. Progressives are great, but they sometimes forget to add up the numbers. Now, that from a guy who's a liberal himself is harsh talk. But let's go to Jamie Dimon. Jamie Dimon is boss of JP Morgan. He's probably, if you asked bankers, the most seasoned. Look, they're the one guys who didn't need a bailout in the global financial crisis. They checked the problems coming. They were the one guys who came through that pretty well. Okay, so what he's saying is, of course, being who we are, while we hope for the Goldilocks scenario, and we think there's a chance for that to happen, and humor me, let me read this a bit because it's quite interesting. So there could be Goldilocks, happy days, but we'll anticipate and be prepared for two other scenarios. The first one, which I won't read, is that COVID mutants just overwhelm the vaccines and carries on causing damage. But then the second one is very concerning. The increased inflation may not be temporary, and it may not be slow. And the Fed will raise rates sooner and faster than people expect. So if I jump to the next slide, he's saying, look, guys, there's three scenarios. Two are not good. The first one is Goldilocks, happy days. You just pump the economy, runs red hot, and there's no negative consequences. You give everyone money, and we'll show you how excessive it's become and why they're historical. You have interest rates at zero. You print $120 billion a month of new money on top of the 4-5 trillion that you've created already in the last year. And hey, everything just works. Okay, so he's saying that could happen. It's possible. It certainly is possible. We agree it's possible. Then he's saying his second scenario is COVID just gets horribly out of control. Some mutations that overwhelm the vaccines, which isn't going to be good for the markets. Then the third one is crash test dummies. The Fed has to hike interest rates a lot faster than people anticipate. And in it, he gives the example of, I remember when Paul Volcker had to increase the interest rates 200%. He increased interest rates by 2%, not 200%, 200 basis points, 2% on a Saturday night, just by the way. So he's saying, look, there's three scenarios: good, bad, and bad. But my apologies. The interesting one is how the market reported that. So I'm reading Wall Street Journal, and you read, wow, Jamie Dimon sees a Goldilocks moment for the US economy. In his annual letter, JP Morgan CEO Jamie Dimon had said strong consumer savings, expanded vaccine distribution, and infrastructure could lead to far sustainable growth. It appeared in the 8th, on the 8th as well. It was also titled, JP Morgan's Diamond predicts a Goldilocks economic boom. Now I'm sitting there thinking, geez, I really respect this guy. Okay, let me go read his chairman's statement, because obviously maybe we're just missing something badly. That's not what he said. Well, I won't go back to the previous slide. What he said were those three scenarios. What he actually said were these, that there are three possible scenarios. One's Goldilocks. The market reported it as that. Now, that's important because there's a sort of very positive psychosis in the market where good news trends. You publish an article, a journal, and it's trending. Now, we're not looking for the bad news. That's why I'd say, wow, maybe I'm wrong. Let me go see what Jamie Dimon really thinks. You come to this scenario here. There's the PCE deflator, which is a more preferred way of looking at inflation. The Fed prefer that way. So in December, before Donald Trump went absolutely mad and promised everyone $2,000, and the Democrats then thought, wow, this is great, let's promise him even more. You can see that was expectation for inflation. This is market consensus of, if you ask all economists what they think. But the expectation for growth has gone from 2.8, 2.9, all the way up to 4%. And there's some guys who are saying 6.5%. But the average economist hasn't lifted the inflation by much. And that's got to tell you there's this, and there's a very rosy view where we've drilled into a lot. So you examine, how does a Fed forecast inflation? They do, like they would pull out a spreadsheet and forecast all the numbers over the next year. The second year, they use theoretical models. Most economists also do a theoretical model in the second year, 2 years out, in 2022. And the biggest factor that goes into the theoretical model is, what are inflation expectations? So a whole lot of economists are thinking, what do you think? What do you think? What do you think? Therefore, it can't go up. And this is the danger what professional economists have got into, that you can't get an econometric model that produces inflation. If you've taught the model and it's a quantitative model based on the last 20 years, because it wasn't inflation, first thing. Secondly, over the last 20, 25 years, every time inflation started arriving, the Fed hit it on the head. That's why you didn't get inflation. Now the Fed are saying, we want to cause inflation, and we're only going to react when we see it out the back mirror, back window of the car. So but there's a bit of a disconnect. But let's go on another guy, Mohammed EL-ERIAN. Now, for those who don't know him, he's a really seasoned commentator, Oxford. He's chairman of one of the colleges. He's ex-chief investment officer of PIMCO, which was at that stage the largest bond fund in the world. He is an economist. He's a boring economist. He's not a lot of people have heard of Noel Rubini, also known as Dr. Doom or Dr. Death or something like that. Now, if we were having Noel Rubini quotes here, you would say, yeah, but you're cherry picking doomsday apocalyptic economists. Mohammed EL-ERIAN is a middle of the road economist. He's as a middle of the road economist as you can get, and a market person. But he's saying, look, here's his quote. So this was quoted on Bloomberg as well. The good news is that there's a window for the Fed to exit in a relatively orderly manner, though it's getting smaller and smaller by the day. Indeed, the longer the Fed delays signaling a moderation of its uber-loose monetary policy, the smaller the window gets, and the greater the immediate and long-term risks of the economy and to the economy and the credibility of the Fed. So this is like, the good news is a small window that they can exit this thing. But ultimately what may happen if the Fed misses the window, I suspect, is somewhere between a May 2013 taper tantrum and a 2008 Lehman moment. In other words, a really, really big smash. So you see, short term, if they exit, and I'll show you the picture. He's sort of, we think in pictures. So he's given you two options. On the left, take the next exit. If the Fed exits now, there'll be a bit of market pain, but it's manageable. If the Fed doesn't exit, you get this is what happens. Like that's that freeway in Cape Town that I think we all know. And that's quite serious talk. It's somewhere between a 2013 taper tantrum and a Lehman moment. So these are seasoned economists. And why are they concerned? That's the US personal income. Okay, I'll tell it, it's not percentage change, it's trillions of dollars. In the days when a trillion was a very big number. So pre-COVID, personal income, the private sector was running at about 19 trillion, apologies. Okay, so because we had this dip in spending because of COVID, they quite rightly did some stimulus, and that caused spending to recover quite quickly. That was, so we were here. This is probably what we underestimated the degree of it, because we didn't think the Fed would be this mad. But this is what they've done since then. So you got into the US election, and it was being proposed to give everyone a $600 check. Then Donald Trump wanted to get elected. So why 600? I'm going to make it 2,000. So the Dems also got on to 2,000, and they've come with a whole lot of other stuff. So you can see personal spending has gone to 24 trillion. So guys, it's a 5 trillion increase in personal income. So I'm not spending income. Okay. Spending has recovered to COVID levels. And that's the good. So if you look at goods, spending is always split into goods and services. Goods is about 1/3, services about 2/3. Goods are somewhere running up here. If you looked at relative to growth, much higher than they were before COVID, because everyone's just buying the stuff. Services is opening fast. The US whole population will be vaccinated in the next month or two. Everyone's going back to restaurants and going on holiday. They're going to spend that money. What we've said in some of our previous presentations, previous versions of QE were because of a whole lot of technical bank things. Most of that money the banks were forced to put back at the Fed. It wasn't really in the economy, the QE, but banks had to increase their reserves at the Fed. So it didn't leak into the economy. This is very different. This is what's getting people like Mohammed El-Erian, Larry Summers, and there's quite a few of them, Jamie Dimon, like, guys, have we gone completely mad here? Because that is and you're seeing it anecdotally, you're seeing it in house prices, you're seeing it in shipping prices, you're seeing copper prices, you're seeing it in Whirlpool. We own Whirlpool shares in our global fund. And they're like, geez, that was fun. You can just put up your prices now. And that has a lot of danger of being inflationary. It's a bit of a wonky measure. It's a thing called the output gap, the red line there. And the output gap is the sort of surplus capacity in the economy. So when you have a corona crash, you get that the economy is performing below capacity. That's why you add stimulus. GFC, the output gap, there was a big stop in the economy, and why you had to add stimulus. Now, that was corona because it was probably the biggest start, and it was right to stimulate. But this is what they've done now. They've cranked the output gap into surplus. And apologies, it's something that gets you excited if you study the. But here's the problem: an output gap surplus at those levels was more commensurate of what you saw in the 70s, when inflation was actually more like 10%. And that's what's really concerning people. If we get in an environment where inflation does start to kick up, you can't have QE. They've got to tighten the budget deficit. You get a massive bear market in equities. You get a major smash up. One of the other problems in it, which is becoming bizarre, is that paying people in the US not to work. So that's the GFC here. You had unemployment shot up, as it should. In a recessionary economy, there's a thing called the quit rate. That's the blue line. You don't quit your job in a big recession because you're not going to find another one. And companies, the yellow line, looking for new staff. Nobody's hiring, and you don't quit your job. Then you had the boom pre-COVID, and you can see quit rate went up because you can get another job. You tell your boss to guess loss, and you go and find another one. You've got the weird thing now. Job quit rate is almost at a record. So people are quitting their job. They know they can find another one. Job openings are near a record. Now, if you split the economy, the big cities like New York, San Francisco, it's still down. Some of the smaller cities, it's way above here. You just can't find people. The big cities, because a lot of baristas, people working in restaurants, that comes back fast. So you can't find anyone to hire. People are quitting their job. And look where unemployment is. Now, that's because you're paying them, in some cases, 50% more not to be at work. So now, obviously, if you've got urgent need for staff, you've got to start lifting what you pay people. That's also inflationary. And that's also, Larry Summers, funny enough, over the weekend was talking, after we'd actually done the presentation, was going on and on about this. It's a really serious problem in an economy. So as I was saying earlier, if I won't rehash it. If you get inflation, or the market gets concerned about inflation, and this is the point, there's more and more market commentators and market participants who's starting to worry about it. In a local fund manager survey or international fund manager survey, inflation is seen as one of the big risks. But here's the problem: no one's taking action for it because the party's so good. So it's a potential risk down the road. And you can see this is inflation. Not a perfect measure, but it's what the market's anticipating inflation, the red line, to be on average over the next 5 years. That's calculating the difference between the US 5-year government bond or treasury and the inflation protected version that has an implied inflation of 2.6%. You can see that's already kicking up.
Rob, just to jump in there, it's important that we separate kind of, there's healthy inflation. Okay, when an economy has healthy inflation, you'll often hear it being called reflation. The economy is taking a hit and it's reflating, it's getting back to where it should be on a healthy growth trajectory. Now, reflation or healthy inflation, that's actually really good for the economy and really good for equities. And so what we're saying when we're talking about inflation kind of getting out of control or surging, we're not talking about 10% inflation like the 70s. What we're talking about is inflation kind of getting maybe just over 3%. And not reverting back to 2%. That's a big enough problem for the market because the market's so expensive and it's baked in these long-term interest rates close to 2%. So the idea is the 2% gets de-anchored in expectations. It starts going up. People start expecting higher inflation, and then that can breed higher inflation. So when people expect more inflation, you end up with more inflation, and it kind of, the Fed has to come in and stop it by hiking rates with a recession. So 2.6 as a number is not dangerous. 2.6 is the Fed patting themselves on the back, saying, great number. That then is going to come down to 2 in the Fed's mind because it's transitory. 2.2, that's fine. That's good inflation. We think that there's a risk, not for definite, there's a risk that inflation moves more towards 3 and doesn't revert back down to 2. And that's going to cause a problem for the economy and for monetary policy and so forth. So there's just a subtle difference between, we use the word inflation a bit generically, and there's 2 types of the healthy inflation and out of control. We're worried about that kind of out of control inflation.
Yeah, and with that personal income number that I showed earlier, you're seeing it. That's what went wrong in Zimbabwe. That's what went wrong in the Weimar Republic. Now, I don't think the US is going to have hyperinflation. We are very, very, very much doubt it. But your risk is you increase the amount of demand out there and you don't really increase the supply of goods. So the price of everything kind of just gets pushed up. And that's probably the most classic inflation, including labor, including what you can sell your labor for. And that's probably about as classic inflation as you can get. And the Fed have then got 2 choices. They can either say we're actually worried about inflation, or they can say we don't care, in which case it carries on going 3, 4, 5%. Now, the Fed are saying it's transitory. Inflation's dead. It's never coming back. And if any inflation you see is just transitory. In fact, Larry Summers, again, it was that same Bloomberg article we were talking about the labor, was talking, say, look, the Fed chairman who spoke the most about transitory inflation was in the 1970s while inflation was going up. And you've got to be it's very dangerous just to dismiss it. So what are the solutions? We think we've got some solutions. That's value trend fund over time. Just manage the risk. Managing the risk is hugely important. Don't be greedy. You can get the returns. So aim for 10, don't aim for 20. 20 is always nice, but be careful on taking on too much risk. We think we can manage our clients well through that type of environment. And we think it's a very good time. The funds are underperformed over the last since COVID, but it's a time to add is not is actually now. Now's the best time to add to a fund like this, and I'll talk why. Here's the 3-year. You can see we're trying to keep the red line just smooth. We're underperforming our peers a little bit. The amount of risk, because the equity markets have just pumped. We've got equity, we just don't have as much. We're just trying to keep that line going up. Just steady. We don't want to be as variable as the yellow line. That's what we do, and we do that a little bit differently. So you can see we have fairly low risk asset allocation here. The actual number is a bit higher, but we've hedged out some of it. The real number is probably about 35, but then we've taken hedges to protect against risk. So we're working hard. We're not doing nothing. And what we got here, we think, a much higher probability of making money. It's not when a lot of this is commodities, which we think actually can carry on making our clients great money. The question might be, well, why don't you put it all in commodities? Well, that's called taking too much risk. What value trend does well over time, you can see there's a standard deviation. So over 3 years, over any time period, it's similar. We're nearing the top of the class on return, and we lower risk, lower standard deviation. In other words, our line tends to be flatter. But the most important part of it, there's a correlation. The other dot, there's our managed plus fund. There's value trend fund, got a very, very low correlation to our peers. That's our peer group, the other multi-asset high equity funds. And you can see there most, and you probably see it if you're looking to asset managers' presentations, most people, there's quite a commonality in thinking. South African shares are cheap at the moment. Best time ever to own equities. I've seen some managers who we really respect have been dropping the exposure down. But most there's a similarity of think. We are prepared to be different. We're not contrarian. We don't want to be different for the sake of it. But you can see our correlation is really low, which adds value. If you're saying, look, there's some chance Rob could be right, Rob and Simon are right, Mohammed EL-ERIAN, Jamie Dimon. Yeah, maybe. You shouldn't have all of the money in the risk. We really think it's time to be putting 10, 20% in funds with much lower correlation. On our equity fund, just some points. We also, advisors and groups who do their own building blocks. We're also trying, even on an equity fund, it has to be fully invested because it's an equity fund. The intersect between, we take risk control very seriously in our equity fund as well, but we do it by how we construct the portfolio. We construct a portfolio with a combination of shares. There's more upside than downside. Obviously, we can't get into the full detail of that here, but the risk stats also look really good on equity fund. Obviously, it's going to be more variable than a balanced fund, but these are equity funds since inception. The blue line is the capped SWIX, and the yellow line is the peer group. So you can see our red line is much flatter, and it also goes up much more. So it just goes to we're not just macro stock where we're just taking a view in our funds where we actually choose the equities. The equities, even in our balanced funds, our equity component works well. We do a lot of work as an investment house trying to find the best place for clients' money. In a shorter term, you can see the equity fund, it fell less in the Corona crash, and has gone up more since then. It's slight outperformance relative to the index, but when something goes wrong, you don't go down as much. It's a good example for clients can go and see the amount of risk you take on. In an equity fund, you can't go more than 100% invested, but the kind of shares you own are very important in that. And you can see on this is a thing called beta, which is it's a little bit of a fund manager thing. If you shares that have a high beta, in other words, if your beta is more than 1, you will fall more than the index when it's fell. So if you look at this fund over here, its beta is 1.3. Its returns better than us. But if you go and look at the numbers, it fell much more when the pawpaw struck the fan in the Corona crash. That's another way of looking at it. There's a return of equity fund, much lower risk stats. You can see there's that other fund. The volatility of that return, a great fund, the volatility of that return is much higher than of volatility. And that's what we do. We different managers do different things. That's what we're trying to do, even on an equity fund. Try to take risk-averse bets, and obviously that equity exposure comes into the element that we're investing in our balance funds as well. And the equity fund, you can see it's got a fairly low correlation to the peer group, which means you can combine it really, really well with passives, get a quite a low cost solution on a building block approach. Yeah. So what we're saying is, some leading thinkers are seeing increased risks of a market dislocation. If you feel there's a non-negligible risk, non-negligible probability of this happening. In other words, yeah, as I said, it might be true. What we would recommend is take some risk off the table. Don't go and hide in the cupboard. We find opportunities are there. That's what we're doing. We're working hard trying to find those opportunities for our clients, and there are some. Just be careful how many you grab. And then we think it really adds value, our style in our balance funds. Find funds that have a low correlation to each other. And there's a couple out there. I know our funds are like that. Keep your three favorites and add a fund with a low correlation, because when something goes wrong, you just get a much smoother result. And we think the risk, is it next week, next month, this end of the year? I don't know, but we're playing in quite a high risk part of time, and it makes a lot of sense. Just if you think there's some chance of any of those scenarios being true, you probably want to. It's been a really, really good market to us. Time to bank some of those profits for your clients. That's the end of the formal part. We've got a little. I've used the question time, but it was Brian said earlier. We love it. What we miss about we used to do these presentations around the country. What we miss about that is being able to sit and jawbone with clients after the meeting, have a cup of coffee, and sit and talk about it. So we treat this part from here on. We treat as that part of the presentation. So we're gonna hang around and chat, and I'll pass it on to Brian, tell you about the CBD points and all of that.
Rob, thanks very much. Very insightful. Thanks, Simon. Like Rob said, yeah, please feel free to go. It's past 11. We did only ask for an hour, but it is great to be able to chat to you and answer your questions. We'll try and get to all your questions. If we don't, please reach out to myself or our team. We've got an awesome team. We've got Jacques, Henk, Leslie, Dale. We want to answer your questions. And also just a heads up, we have been given the opportunity to be a part of the investment forum, which is happening in June. Rob's going to be on the plenary, so-called virtual stage, with some of the other big companies out there talking about asset allocation and how they see it at the moment. And then Simon will also be doing a breakaway session talking specifically to our equity fund. So with that, thank you very much for your time, and Rob and Simon will continue answering your questions.
Well, so not Brian. You obviously, if you leave now, it would be sad to see you go, but you do get your CPD points. If you've got your sound off for the whole presentation and you can't hear me saying that, not what you can do to help. But yeah, thank you. For those who have to leave now, we just really thank you for being on, and we'll carry on asking. I see there are some great questions logged there, which Simon will pop up.
Great, yeah. So I've got quite a few questions here. So yeah, push them through in the Q&A, and we'll just try to keep this interactive. I'll bounce them around on the team. So keep pushing them through the Q&A. Just an important one, we didn't talk too much to allocation-wise, just from Mark, just asking what percentage of SA shares are Rand hedged versus kind of inks, obviously assuming SA inks there. So Mark, yeah, it's a good question. We're cautious on South Africa, on the South African economy, and we like mining shares. So the portfolios are very much have very little SA ink. So Value Trend, for example, has about 2%-3% equities on look-through basis in SA Inc. And we generally fairly defensive on the SA Inc. side. So the stuff we own on SA Inc., say the hospital groups, which we think have been oversold and earnings will normalize pretty quickly post-COVID. So we own the hospital groups. We own the more defensive side on the SA Inc. So an equity fund, for example, we'll own the kind of food producer, food retail emphasis over, say, going for SA Inc. shares that are more exposed to discretionary spending, which Rob had that slide up, if you recall, just how the South African consumer has been juiced by grants, cuts in interest rates. You know, the advisors on this call will know you even had holidays on retirement annuity contributions and things like that. So we think the base has been kind of goosed with support for the SA consumer. So the discretionary spend, we're a little bit, we're very cautious on in South Africa. But that's more to do with the equity fund, where we need to be invested, right? Whereas in the multi-asset funds, where we can sit in cash, we've generally avoided SA Inc. It's kind of low single digit exposure. And then just bear in mind that Managed Plus and Stable Fund, they can use derivatives to hedge. So there's a put option in place on those two funds against the JC Top 40, hedging a bit of the equity risk locally. Value Trend by mandate doesn't use derivatives, and so it doesn't have a hedge. And the track records there, you see, we manage the risk with active asset allocation and stock picking is how we've always managed the risk and continue going forward. So pretty low. Okay. And then quite a bit of...
If I can just clarify that value, we're saying that graph of Value Trends exposure, FX was about 33, or the long side 33. You know, we invest through our global fund, which is really great low volatility fund. We invest in, we don't charge the fee twice, obviously, as an asset manager, but our global fund has hedged its equity exposure. So that's, yeah, I don't want to confuse you what I'm saying, what Simon's saying. Value Trend itself doesn't have hedges, but it can do it through its investment in global fund.
Yeah. Okay, so I think that hopefully, Mark, that answers your question. If not, just type a follow-up. I've got them all in front of me here. Okay, anonymous, the name didn't come through, but important point of clarity, we're concerned about inflation. And if you look at our fact sheets, you have a high allocation to US Treasuries across your multi-asset funds. So that's an important point for clarity. The answer is fairly simple there. Although we own US Treasuries, we own very near-dated US Treasuries. So we're not taking a lot of duration. So globally, we're not taking any duration. Locally, we're mostly in short-dated South African, where you see South African bonds or government bonds, short-dated. And then the funds have about a 10% allocation to the R2030, so kind of South African 10-year. So there's a relatively small allocation, and we're fairly active around our duration exposure locally. You know, if any political risks flare up or something like that, we're very willing to go down to zero. But obviously, the yields are good at the moment. But generally speaking, across the funds, we've got a very, very cautious view to take any duration and any kind of quasi-duration, say through a property share or through corporate bonds. So not just about government bonds. We're avoiding risk of interest rates going up. The same thing goes for some certain types of equities that would lose a lot of value if interest rates went up substantially. So tech shares and so forth.
It's just an important point to note on that. We started talking. We've got a bit of duration in South Africa. We've got about 10% in government in 10-year South African govies. Now you could argue, and that's one of the problems with the income funds. We don't have an income fund because, and our concern is this, that income funds historically you could get about an 8-9% return. The problem, the only way you can do it now is if you go full blown into like 10-year duration, 10-year South African government bonds. And we like the trade. That's why we're happy to own 10% of it. But you've got massive risk, because if in 2013 you had a thing called the taper tantrum, where US interest rates, bond rates went up a lot quicker than expected, and emerging markets, government debt got smashed. And that's one of the big risks we see out there. It was not good. It wasn't bad for equity markets in that environment, but very different because equity markets are very, very cheap. But bond markets got killed, particularly EM currency and EM bonds got really killed on that. So we're happy to have 10, but it's a scratchy 10. One of the other difficulties in we're talking on income funds is you could get about 8% on no duration if you just own floaters, interbank floaters. A South African major bank floating rate notes, you could get your 8.5% plus. you can only get about 4.5% now, depending on the term on it, because interest rates are lower. So if you don't want to take duration risk on bonds, which is quite significant where we are, you're stuck at getting kind of 4.5, and then the fund takes its costs, and you kind of probably end up more like 4. So forward-looking income fund returns are not going to be the same as historical thing. I'm actually going to show one graph we were thinking of. I'm going to put it on. We didn't want to get on rabbit holes. This is JAR rates, interbank note rates. So this was JAR rates that you could always normally get about 100 basis points premium. So you could buy one year JAR. This is what banks lend to each other at, and you could earn, eight. You could get like 9% on a 1 year JAR. And this is taking no interest rate risk. You're just taking a risk that First Rand or Standard Bank's going to go bust. So as an income fund, you could literally wake up in the morning and do 10 minutes work, and you could get your 9%. It wasn't really very hard. And funds like we would invest in that type of thing too. Most balanced funds would. Here's the problem now. Look where the JAR rates are. So you not taking big risk in income funds. You're only going to get your 4%, 5%, and then the funds need to take a fee, and you end up at 4%. That's the problem. So to keep going at the 9%, you need to take on a whole lot of interest rate risk,
which we're not willing to do. Just to be clear, we're not taking that risk.
That's why one of the we ran out a bit on time of it. A huge solution for investors is stable funds relative to income funds. We have a stable fund, a good stable fund. Really look at stable funds. Income funds will not get the same returns going forwards as they got backwards over the last 5 years. It's impossible for them to do that.
Then just to follow up from Mark, just on the risk between value and manage with reference to use of derivatives. So maybe we weren't clear there. So Mark, thanks for following up. So value trend by mandates doesn't use derivatives directly. So it won't ever hold derivatives directly. It does invest in the Rezco Global Fund, which can use derivatives. Okay. But broadly speaking, the value trend fund and locally won't use derivatives. Managed Plus is allowed to use derivatives only for hedging purposes. Okay, so there's a distinction between the two funds. And so currently the positioning, Managed Plus, given our view on risk, has a put option to protect against a fall in the JSE Top 40. It expires in June, so a short-dated put option. And that's held within the fund there, whereas Value Trend doesn't. But Value Trend also will hold kind of lower equity exposure, and we can be active around the asset allocation locally to manage risk. So hopefully that's clear.
Just to say on our global fund, we've also taken quite a low risk approach. Just it's a flexible fund. It's some clients really find it's a great thing. You can go in through the big platforms like Allen Gray. We've got a local feeder fund where you can put rands in. So if you're looking for a little bit of risk balance, it's a great one to do that. It's a similar kind of strategy, reflects the same. It's a flexible fund which has got at the moment almost all the equity risk. You can see it has been going up, not as much as the market, but ticking along. It's a great low risk product as well, which is now available through the major platforms.
So Lubabalo's another question. So thanks for asking this. If equities and bonds are expensive, what do you buy? That's an important question. So we cautious around kind of the aggregate valuations. Rob had all those charts. We wouldn't buy just a generic basket of equities or generic basket of bonds. In aggregate, they're expensive. We are finding some opportunities within bonds. We're not really, other than some the SA bonds globally are actually fairly attractive, relatively attractive. But broadly speaking, we're not taking any risk across bonds. We think corporate bonds are expensive. You can't shop around in bonds and find, like a Coca-Cola bond trading cheaply, and all of a sudden you get this wonderful yield pickup. They just broad, because of all the money that's gone in by QE, all bonds are expensive. Okay, so there we're not picking bond opportunities. Equities, however, is different. And aggregate equities are expensive. We wouldn't just buy a generic basket, but there are some stock picking opportunities. And so we do have exposure to equities in the funds. In the global fund, and there was another question from an anonymous attendee, so we overlap a little bit, just saying, please talk to the global fund a little bit, the Rezco Global Flex Fund. So in the global fund, what we've done is what we have is what's called hedged equity. So you can short index basket, say S&P 500, and then you can pick shares on the long side. And so you hedge out your market risk, but you just get your stock picking risk and return. And so the global fund has about 35% long equities and kind of resources and stock picks, a lot developed markets, say US and Europe. And then we short 30% S&P 500 and a couple of mining shares to hedge off in the stock picking. So we've got some hedged equity in the global fund, quite a big position, we think, relative to the risk in the market. So we're taking risk, but we think that's a good risk to take. So our job is to take good risks and to avoid bad risks. So we think a good risk to take in this market is to be stock picking, but you don't want to take the market risk, hence why it's hedged out. And then in the global fund, just stick with there, I'm kind of answering two questions at the same time. In the global fund, we also own mining shares directly to add to the equity exposure. And locally, mining shares are the predominant weighting in our multi-asset funds, specifically the PGM miners. And then also we own palladium as a commodity. We own it an ETF of that commodity. So physically backed investment into palladium. And so the funds have quite a big position. Managed plus value trend have about 5% allocation to palladium as purely as a commodity. And then we also own the PGM miners. So that's the area where we're most constructive. But broadly speaking, mining is a sector which we like. So we think there are stock picking opportunities, Lubabalo. It's just that the total risk in the market's high. So even though you like your shares, this is where that risk discipline comes in. You think those shares are going to do well, why don't you own 60, 70% of the shares you like? And we think that the risk is, yeah, we like those shares, but there's still downside. Should inflation kick up, the market become dislocated, there'd be a market correction. Even cheap shares or well-researched, good value shares with good growth prospects, they're still going to fall if the market falls. And so we want to manage our risk really carefully. And there's always a risk as asset managers when you're stock picking to fill up your basket with all your favorite shares and say, well, the market's expensive, but my shares are cheap. And so I can be fully invested because my shares are cheap. But the reality is everything correlates when in a market correction. If there's a bear market, you can pick the best shares, but you're unlikely to get positive returns in a kind of horrible bear market. And so we just manage the total risk carefully. And so we don't have too high an allocation, even to our favorite shares.
Lest the clients think there's people in that's the Johannesburg office behind Simon there. There's people working. It's not like we say, market's expensive, let's leave the party and do nothing. We're working jolly hard and we're finding stuff we like when I mentioned earlier, I think like Whirlpool, some of the home builders in the US, you can still make a little bit of money, but there's a long list of vanadium miners with Largo, they're making a vanadium battery. You can find these opportunities to scratch, but it's a sort of lower risk. South African bonds, you can make a little bit of money. We've got 10%, don't have 50% in South African duration. You can scratch around. We're doing a lot of work on a machine learning. We've got a couple of percent in value trending or machine learning models. We're working, understanding more and more. We've been doing that for a couple of years, how to really use the software to really get returns. It's complex, but it's not about taking huge risks. So, we've got this. You want to be hedged. You want to be market neutral, which is scratchy sort of environment. It's much easier to own Bitcoin and it goes up 500%, but we just don't think it's kind of hard work market. So we've got to work harder than we've ever worked, trying to find those opportunities and then hedging it out with something you really don't like, and trying to be careful at the same time. The South African balance funds have obviously that's where we think balance funds will do better. They need that rand exposure, that hard currency exposure, and you have a little bit of, some bonds, some currency exposure, some commodities. Someone talking about the direct palladium, about 25% in some of the mining shares. You build a portfolio that'll get you the returns, and trying to protect some of the downside if something really goes wrong. That's what we do. So it's not like we've left the room. We're working hard and finding those alternatives. Very excited going forward on what we got coming down the pipeline in machine learning. That looks really, really interesting. But it's all little pieces that you add to the equation. We find a company like Deutsche Post in Value Trend Fund has 1% of the fund. It's great. Courier companies doing well. You build the fund, you build the solution like that, rather than taking massive bets and just hope everything keeps going well. Because it's my experience, and we've done it quite a few times. You've got to be when the party's going full bore. It's got a nasty habit of ending, and you're finding that a bit. Some of the companies announcing spectacular earnings at the moment, and the share price goes down. Why? Because it's already all in the price, and a lot of this really booming economy is in the price of the equities. What's not in the price is the interest rate risks that are coming down the line.
And then another question from Daniel. Daniel, I see you still online. So he asked the question at 10:05, but it wasn't in the presentation. So I just want to run through some of the other kind of areas of global markets. Where do we see value? So local equity versus emerging markets, developed markets. Is India going to be a major problem for returns going forward? And thoughts on property. So just to kind of cover some of those other asset classes fairly briefly. I can't talk to them too much, Daniel, but important that we touch on them and our positioning. Firstly, India, unfortunately, a horrible kind of COVID surge happening there. But when you put it in context of the size of the population and their contribution to global kind of GDP, we don't think that that's going to kind of derail the kind of global growth story. So it's not going to be a major problem for global returns as it is. Of course, one of those risks was the mutant risk, and I'm not going to go into long detail on COVID, but obviously the more people that have COVID, the more risk of a mutation that comes through that evades vaccines. So you've got to kind of watch that mutation risk quite closely. If there's countries, Brazil, India, or so forth, where there's surges, and then you've got to watch for mutations and so forth. But broadly speaking, we don't think, status quo as it goes, it's going to derail global growth. You've got to be careful of emerging markets. It's always, so on the one hand, global growth is great for emerging market equities. Generally, when the economy globally is growing well, trade is going up, and emerging economies do very well, and the equities can do well in that environment. But the problem is emerging market equities have rallied already, and they're quite expensive. And the opposite's also true. If the risks come to the fore and people stop looking at all the good news and inflation starts ticking up, your EM is your kind of high risk geared exposure, and you take a much bigger hit on emerging markets equities. So we're cautious. We haven't positioned around a lot of emerging market equity, other than say mining shares, which to some degree sit within emerging markets, but it's not kind of a pure EM kind of play. Locally and property, we're still cautious. We think that there's still kind of headwinds coming in local office and local retail. We don't think the sector's out of the woods. You're seeing a lot of deals and stuff trying to clean these businesses up, and the shares are popping on some news and buyouts and so forth. So there's quite a lot of activity happening. I think that's more just a sign of the stress than it is a sign necessarily of the opportunity. But we're still sitting out of property. Just structurally, we think that that in South Africa there's just too much, and it still needs to wash out before we start seeing value. So I hope I've covered the kind of this asset classes that we didn't really cover in the presentation there. Then just a question on inflation and transitory, just some more specifics. So also anonymous, but how much longer before we will really know if the expected US inflation is core or sustained? So if it's going to just carry on, or if it's transitory, months or years. So it's a good question. It requires a fairly complex answer. Okay, so transitory inflation. What do people mean by transitory inflation? So inflation kicks up, but it's due to a supply shock. It's due to a mismatch in supply and demand. So the US economy historically has been very adaptive to the economy, and so if demand surges, normally there's a supply response. So what at the moment there's been a demand surge, and the argument then is yes, prices are going to kick up, but wherever there's shortages, entrepreneurial Americans will open up businesses and supply into those shortages at high margin, and it all works itself out, and then it comes back down to 2%. So that's an important part of transitory inflation. The other important part of transitory inflation is expectations. So if inflation kicks up, but the expectations longer term stay anchored to whatever the target is. So in the US, we'll call it 2%. So inflation goes up to 2.5, 3, but the consensus in the market is that inflation in 5 years' time will be back down to 2.2 or 2.1. Then that's saying that your inflation expectations are anchored. So those are two main things around transitory inflation. Okay. So now what's happening at the moment, and when will we know whether this inflation becomes self-reinforcing? That's the dangerous inflation. So it's just kind of snowballing type inflation, or whether it's transitory. So the things we need to watch will be whether the expectations for inflation move up, and there's a couple of risk periods. The next few months is a big risk period. So we know because of base effects and because of supply shocks that for the next 3 months, 4 months actually, US inflation is going to kick higher. Okay. Now, the bulls and the Fed and so forth are saying, yes, that's short term, it's going to go back. But what could happen over the next 4 months is expectations for inflation can move up. So long-term expectations. So it's kind of a de-anchoring based on the current inflation. People's expected inflation can go up. The problem then is if it starts going up, that's a key input into everyone's models. And so then models, economists start forecasting higher inflation, which could beget higher inflation. So you get this problem if inflation expectations start kicking up. If they don't, and everyone believes the Fed, there's another point later in the year, towards the end of the year, when inflation should be falling rapidly, like mean reverting down. If it doesn't, that's another big risk period for inflation. If inflation expectations kick up at a later point of the year when they should be mean reverting. Okay, and then as far as supply shortages go, if we don't see a supply response, and or we see companies just hiking prices, like what we're seeing now, then those transitory factors could pass out. An anecdotal example I'll give you is the US CPI number for appliances. Okay, is running at about 8% year over year. Now, bear in mind, appliances usually deflate. Okay, so appliances get cheaper and cheaper every year in the US inflation numbers. So it gives a negative number. Okay, there's good reasons for that. It's not a mistake, but basically they're saying the washing machine gets cheaper every year. Now they're saying actually appliances have gone 8% year over year more expensive. And then Whirlpool, one of the largest appliance makers in the US, said, okay, that was what you've seen up to now, that 8% inflation was just us stopping to discount. So we're just charging full price instead of discounting. But because of our cost of goods, we actually need to push prices up another 5. And so what you're seeing now is inflation on top of inflation. Now, if that's an anecdote, if that spreads throughout the economy, you've got a big problem. And then you'll know it's not transitory.
Yeah, I mean, I was just trying to find a quote here on my iPad while you're talking on the Warren Buffett's chairman's letter, talking about, look, we comment, and I'm paraphrasing it, so pardon me if I get it slightly wrong, is we're seeing inflation all over the place. Now, Berkshire Hathaway is across lots of industries. It's a huge business. We're seeing inflation all over the place, and we're putting our prices up. Just, you see Ford, you see anyone putting our prices up. Why? Because they can. So you are seeing that, home builders, airlines starting to, you've got car hire. Don't try hire a car in the US. Prices are doubled. You're seeing it, but one of the errors, it's an error of thinking in our view. So what was a big area in the GFC? Why did it go? Because it was based on an assumption that house prices couldn't fall everywhere in the US all at the same time. Now, it sounds bizarre, but literally that was the assumption because it hadn't done it in the past. Now, so you could take rubbish collateralized mortgages from San Francisco and combine them with Dallas or some other place that didn't correlate. And hey, presto, you got a AAA grade product. Now, if you look back, you think, why was it a rule of finance in the US that the numbers could never fall? Apologies, sorry, I should have why were you assuming it could never fall? Well, just because it hadn't. And this is the problem you're getting in inflation, is people are saying there can be no inflation because there's been no inflation for the last 25 years of any serious magnitude. But they've also done things in the last 6 months that they've never done in the last 25 years. Cranked the Fed balance sheet by a couple of trillion, put that couple of trillion in people's pockets. At the same time, put interest rates to 0%. You go down the list, there's quite a few things you've never done. And that's this inherent assumption you can't have inflation because there hasn't been inflation. And the more you drill into the details, because we speak with economists, just give us understand your model. Okay, what have you got to change on your model to get inflation expectations? And but inflation expectations is what other economists think. But all the economists won't change expectations because they all think everyone else hasn't changed the expectations. And then there's more sort of market nuanced numbers as well. But it's dangerous because you're seeing it there. Case-Shiller house price index is running over 10% in the US. Okay, apartments have got cheaper because everyone's left and gone to the things, but they've got to come back to the cities now. So apartment rentals are going to normalize. You've got people with massive amount of money in their pockets. And what do? They spend the money. And here's the problem, same problem why we don't like bonds in South Africa. What happens in a democracy, in its worst case, is that people vote themselves an increase. So these handing out money, which is very un-American, it'd be very popular. Democrats love it, they're in power. They say, hey, look, when we do surveys, half the Republicans like it too. Everyone likes it. And you get this sort of populist type of economics. Now in South Africa, we have a danger of a similar thing. Hey, how about a social income grant? Everybody gets a couple of grand a month. Who's in favor? You know what? Most people are going to put up their hands. And that's part of the, particularly US economics have gone sort of very populist because everybody wants a handout. Everybody wants a free check in the post for doing nothing. Everyone's in favor of, I'd like to rather get paid to stay at home than go to work. You've got, so that's the danger zone you're in, which you something breaks. The market is going to anticipate. Markets have a tendency to anticipate. It's going to be too late when you haul out your Wall Street Journal and says there's inflation. The second point is, and this has got to concern you as a market participant, the Fed know how to, they say, we're not worried about inflation because we know how to fix it. How do they fix it? They jack up interest rates. So if the Fed is saying, we don't care, if we get inflation, we can fix it. If they get inflation and they fix it, it's going to murder the stock market because a big hike, unexpected hike in interest rates is going to hurt your equity prices a lot. And that's the risk we need to, the Fed changed its mind. The previous one they did is they said they were going to shrink the size of the balance sheet. Technical term, they're going to wind back a bit of the QE that they did since the GFC. And Jerome Powell said, look, we've got it on autopilot. We're going to do X. I think it was 50 billion a month, and it's working on autopilot. It's like a clock. We're not even going to tamper with it. I think they did it for about 9 months, and then they stopped because it was causing the market a problem. Changed their mind. No, we're not going to do that. So the assumption that the Fed doesn't change their mind, if they change their mind, it's going to cost equity owners a lot of money.
And so just to wrap up that question, because it's a really important question. So when will we know? Very important in this kind of market timing versus risk management. It's not that specific when we'll exactly know by this date, But we do think it's not you said months or years. We do think it's a matter of kind of within about 6 months, 6 to 9 months, we should have a fair amount of clarity around the direction of inflation. It's not a case of waiting for years. So inflation is fairly slow moving, but because of COVID and the way that some of the dynamics in the economy have changed, in this case, it could be quicker moving, as opposed to a normal, very slow moving build-up, a multi-year build-up of inflation. We don't think that's what's happening here. A multi-year build-up of inflation is generally called reflation. It's a great time for an economy and equities. We think that there's this surprise in inflation that catches the market off guard. And that's shorter, but it's not necessarily, the next inflation print. If it's not a high, then we made a mistake. We analyze every data point in the inflation print and we check it against our modeling. But it's a multi-month kind of period that we think it will become clear if there is inflation. We're not saying we're 100% sure. We're saying it's a high probability.
Sorry, Simon, interrupting. Just to make it clear, in the context of the title of the presentation, so a logical investor might say, well, let me just stay in the market for 2-3 months. I'll ride this horse a bit further and I'm going to make some more money. So why sort of trim risk now? That's called market timing, because the market is a way of anticipating things, a way of reacting ahead of time. And market timing is great. I'm going to ride this thing right to the end. A month before there's inflation, I'm going to have been gone. We're not that clever. We're just saying there's risks building, and markets have a nasty habit of, so it could be from 1 day to 1 year. But markets will anticipate, and when you least expect it. What's the last snow? You already see more and more commentators. Well, guys, there's a problem here. Guys, there's a problem here. You weren't seeing that at the beginning of the year. You're seeing it now. And when do equities just start going down, even in the face of good news? Now, market timing is, I can ride this thing right to the end. A month before it turns down, I'm out. We don't. It's not what we don't want to try that. That's bad risk control. You might get it right, or you could lose a hang of a lot of money.
Yeah. So I was just typing an answer to Mark quickly while you're talking, Rob. Another important question, just coming back to South Africa. So as we head to 2023, and Tito's warning of a fiscal cliff, do you think we're on track for this? It's an important question on the local side, and especially when it comes to our bonds. So our bonds are South African government bonds. We debate them a lot, okay? Because here's a situation where the asset isn't expensive. South African bonds are, I'm talking about bonds with duration, your 10-year, and if you go further out, you kind of go to your 20-year type bonds. South African bonds, government bonds are relatively cheap, okay? So that's important in the context we've been speaking about expensive markets, but locally we have this cheap asset. Now cheap in absolute terms, not necessarily relative to risk. And that's the problem here, and that's what you're pointing to. So Tito's fiscal cliff, that's if we do nothing, everything falls apart. We have to do something, okay? There's some risk to this. We think, Rob had that slide up of the different budget deficits. I think when he was talking, he just alluded to the reality is we'll end up between the two. The reality is South Africa works with negotiation between government and labor and business. A lot of negotiation. That's the problem at the moment, is a passive approach leads to a fiscal cliff, leads to debt getting out of control, and so forth. So the problem as a South African focused investor, the passive option is dangerous, and we're so used to passive when it comes to how the country's run. There's a lot of debate, there's a lot of good policy on paper. We're not used to actual execution. And so that's the reason, one of the main reasons, that and political risk, why our bonds are cheap. And we think those are both fairly reasonable risks. We're not saying it's our base case that the politics gets worse, with ACE potentially leaving or not leaving, hanging around and so forth, and cleaning up corruption and Zondo Commission and so forth. There's a chance that actually there is a bit of a cleanup. But there's also a chance that the cleanup doesn't happen. And internally, the ANC struggles with their rules around members leaving when they have charges laid against them and so forth. So that's the one risk. The other risk is this fiscal cliff argument. It's not as Tito's job is to scare the politicians into action. It's a tough job, and so he needs to come out really strongly to convince politicians to act. And so that the kind of the worst case scenario, he might have embellished a little bit. You can see tax collections are a bit better than expected. Trade surplus is going quite nicely, and so forth. Sorry, not tax collections. I'm getting confused. The budget numbers. The tax revenue's been better expected, and the budget deficit's been a little bit better than expected numbers released. I think Friday. In South Africa. So there is a little bit of good news in the economy. But I think he's trying to highlight the risk so that ministers act in this regard, and also a warning to Labour that we can't carry on like this. So it's not our base case that we hit a fiscal cliff and everything falls apart in 2023. That's on our base case view, but we acknowledge the risk of something like that.
Your big risks are like, I mean, even I was saying in America, which is the most sophisticated capitalist economy, you get this creeping populism of, even if you couple, you're earning $150,000 a year, which is a fair amount of money, even in America, like treble the average earnings. They still got stimulus, check in the post, and you've got a job. You've got no chance of losing your job. We get this similar thing in South Africa where you start saying, but we did the 70 billion COVID UIF. Why don't we just keep it going permanently? Why don't we just give everybody money and we'll find a way to do it? Well, let's just run the budget deficit at 7-8% because we sort of can. You get creeping sort of socialism. If you've had it in America, the most capitalist economy, you have it because the downside of democracy, and I think democracy is the best system, is everyone votes themselves an increase, and they want someone else to pay for it. Which we haven't even discussed one thing in the US, increased taxes. It's a big problem. It's become, let's soak the rich, soak corporate America, let's jack the taxes up to pay for the goodies we're handing out. Is very dangerous. I mean, Warren Buffett was on the same thing on the weekend, was 99% of my money is going to philanthropy, so I don't care. But you know what, if the government took it all, I also really don't care. And you're getting a lot of the sort of lefties, Jeff Bezos, we should be paying more tax. It's fine if you've got $100 billion, you could pay a bit more tax. But you're getting aggressive against corporates. And when you own an American company, you own, as a shareholder, if they increase the tax, you got less left for the shareholders. So in South Africa, it is a big potential risk.
There was another good question talking, what is the way the Fed could exit the madness in inverted commas without a smash up? So obviously, Mohammed EL-ERIAN talking about, well, you can take the turn off. First point to note is he wrote that before the latest FOMC meeting. So they drove past that turn off. There's maybe another turn off. So what can the Fed do now or in the short term to avoid a smash up? Because it's not guaranteed that there's a smash up. It's not 100% sure. We deal with probabilities and risk, right? So what they could do is they could start signaling fairly subtly and early. They could wind back some QE. It will cause a bit of a dislocation in equity markets, but it won't cause necessarily a smash up. The problem is they would have to kind of go against some of their prior comments. So what they've said is that it's too early to even talk about it when it comes to winding back QE. They've made a couple of comments now around maybe early next year. But the other problem that they have is the Fed's become very focused on labor measures, okay? And so they've been saying broad-based, fully employed. So that means that that's a little bit more subjective. And so what they might need to do is wind that back a little bit and acknowledge inflation risks as well. So the Fed's got this inflation and full employment, and monetary policy tries to adjust between the two. Okay, so we know that in the inflation kind of smash up of the 70s, everything became, the central bank's focus was controlling inflation and letting the economy and labor and employment do what it needs to do. The current positioning of the Fed is everything's focused on labor and let inflation do what it needs to do. Even so much so, it's saying let's just target average inflation, not even an upper limit. So I think, how do they get off the highway at the moment? They'd have to wind back their intense labor focus, wind back their broad-based measures. So broad-based measures, what are they talking about? They're talking about very important things like women in the workplace, minorities, and so forth. Very important. We just think that that's the politician's job to fix those structural issues in the economy. You shouldn't use monetary policy, printing cash, zero interest rates to try to pull necessarily minorities into.
I didn't get that.
Sorry about that. Minorities into being fully employed. So they're very, very focused on that. It's a very important goal. We just think that if monetary policy is used as the instrument to do it, you risk a lot of inflation. So it would be a bit of an artful thing to get off the highway at the moment. They can do it, but they'd have to backtrack, I think, a bit on some of their very strong statements that they've made recently. So it's quite a difficult highway to get off. But we keep an eye on it, because if they do, you could be in for a short-term small correction in equities and a reflationary economy that you could buy equities in.
The problem? So never fight the Fed. Okay, so absolutely, we agree with that. Often, but here's the problem: is the Fed is in charge until they're not in charge, and we've got an analogy which guys beg me not to use, but I'm going to do it anyway. Which is we have down in the Eastern Cape, every now and again you get a guy who starts farming lions, and he dominates because he's grown these lions since cubs, and he can go in there and he smacks him with a chair and the car in the corner and he's boss, and it works well until the lions one day eat him, and it seems to happen scarily regularly, because the lions can always eat you, but you've got them covered and you can crack your whip, and you've got a lion tamer and wave the chair at them. But what gets out of the Fed's in charge, the one line that's bigger than the Fed is inflation. The Fed are then not in charge, and that's the potential problem. And there's more and more the market's sitting and saying, but you're kidding us here. So there's that credibility. Inflation's not there because if the Fed say every time we see inflation, we're going to kill it. So you get this sort of mindset there can be no inflation, and that's disappearing fast. Whereas everyone's saying, but we're seeing inflation everywhere. House prices going up 10%, shipping goods from China are up 400%, copper, corn, cars, car hire. You're going down the list, and every CEO is saying, yeah, we're putting our prices up. It seems good. The credibility of the Fed starts to disappear, and you've got 4 trillion in people's pockets that they want to spend. Now, at that inflation, the Fed or the lion tamer, who sort of goes a bit pear-shaped, they have to react, and react is jacking up interest rates, and that's messy. That's the point Jamie Dimon was making, where Volcker cranked interest rates up 2%. The Fed do 0.25%. This was a 2% increase all in one go on a Saturday night. Now, for a seasoned banker to mention that, I'm reminded of the time, that's a possibility of if it gets really out of control. Look, I think as an event, I'm not sitting waiting for the Fed to put up the interest rates 2% in one go, but it shows you the potential risk. The market sits and says, but we don't agree with you anymore, and that bond rates start to go up. And the Fed lose control and have to assert their credibility again, because bigger than the Fed. I think we use a previous presentation. The Fed's a £1,000 gorilla. The £5,000 gorilla is inflation. Inflation starts to get out of control. The Fed have to react. They can't just say, we're in charge, we're going to print money and keep interest rates at zero.
So we're almost at the end of the questions. Mark Liddy's got a few questions here. Just kind of concerned around free money, employment. How can the US increase employment with free money? You can get the economy going again with free money. So what the US did through COVID, we think was justified and made sense, and in hindsight worked. Okay, so you can. Now, there's a divergence, and this is where we kind of get a little tricky. Okay, so I'm sure you heard of modern monetary theory. This idea that you can print money, and as long as you spend that money well, it's okay and you can keep doing it. Okay, and then you target tax increases. That's also part of modern monetary theory. So if you print money and you build infrastructure, if you print money and you really get the economy going with really good quality investment, doesn't have to be physical infrastructure, it could be R&D, it could be all sorts of things like that. Then you can get, that's the theory, how the theory goes, you can increase, you can grow the economy and you can increase employment. Our concern is that there's a bill to pay. And when you do have to pay the bill, it has the exact opposite effect to destabilize the economy. And you can't just print the money for free. And so that's the disconnect. So modern monetary theory says, yes, you can. And if you need to, you can target tax and increase tax rates, and it'll all work out. Our concern is that increasing tax is complex, especially in the US. It's easy to spend money, it's harder to collect it. And obviously increasing tax can have kind of a negative impact on the economy. So we're cautious. We don't think you can sustainably increase employment with free money, but we do think that you can patch a wound, a GFC, COVID crash, things like that. It can make sense. So we're cautious there.
Free money, they're paying people not to work. That's that one graph I put up. It's actually almost opposite at the moment. You've got these enhanced employment benefits till the end of September, so a lot of companies are saying we just can't find anyone to work because clearly people aren't stupid. You can earn more by not working than working. And they can only do that because of the free money. So it's almost the opposite. You're keeping the unemployment number artificially high because you're paying people not to work.
So one last point, maybe to wrap up this, and the inflation thing is on that, is why is unemployment so important for inflation, right? And it's because you look at wages. When unemployment is very low, economy is pumping, wages are ticking up. So the economy is tight, supply is tight, wages are ticking up, and that's an inflationary type of economy. But also because wages are ticking up, the consumer of services and goods in that economy have a lot more money to spend, and so they end up spending more, and it becomes kind of self-fulfilling. Okay, so employment's important because of the pass-through to the economy, as employed people are the ones who are spending, and also wages are components of cost for a business. Now, the problem that you have in the US economy at the moment is costs are going up for businesses. Even wage costs, even though there's a high unemployment, wage costs are going up because you've got to incentivize people because of COVID and their stimulus and benefits to come back into the workforce. So whether you have the employment or not, irrelevant, costs are going up. And then on the spending side, whether you have the employment or not is irrelevant because personal income's up. So it's very misleading to say there won't be inflation because there's unemployment. Because unemployment on its own doesn't cause inflation. It causes inflation because wage costs go up for companies or because spending goes up, and both wages and spending is going up. And if you're staring at employment, you're looking at the wrong problem. And so we think that ultimately that means inflation can come through and surprise, because everyone's staring at unemployment when they should be staring at cost of production and staring at the strength of the US consumer. To demand goods and services, and those two indicators we think are flashing red, and unemployment's flashing amber if we're in America. So that's kind of our concern. Then we've pretty much answered the questions. We do have a couple of anonymous questions we haven't answered, but I think we've had a good coffee chat. Obviously follow up quickly, but I see there's no more follow-ups on the Q&A, so I'll hand back over to Rob and Brian to close off.
Yeah, so just from our side, really we'll pull at the end. You know, Brian will for CBD points. We said that it's the normal procedure, same as last time. Really appreciate everyone's support. If there's other questions or you want to clarify a bit more, please get a hold of us. And thank you very much for being on the call.